Well, I have two parts. The first part is about the big tech innovation, and the second part is its interaction with the financial institutions. I have to say, well, Huang Hao just said he tried very hard to avoid talking about the lending, which is good because all of my discussion focuses on lending. But Huang Yi early on, somehow we all shared the same surname. But anyway, Huang Yi already had some discussions about the similar topics I'm going to share. So the first part, I will try to run through relatively quickly innovations by the big tech. And one key message I'd like to share with you that's been stressed again and again. That is financial inclusion. This is the main contribution by the big techs. This is an index called the Peking University Digital Financial Inclusion Index. We did it in collaboration with the Ant Group. So all the municipalities were colored according to their level of development in that particular year. The most advanced, the red, then orange, then yellow, and then green. If you compare the two maps, the left one is for 2010 and the one on the right is for 2021, you can see that over time the color actually converged, which basically means the lagging municipalities were catching up very quickly, and that was one key message from these two maps. And we have annual indicators for provinces, municipalities, and counties, but they show the same message. And I think this is very powerful. What I like to just say a bit about the financial inclusion, the first thing we did was, well, when I heard that big techs are doing lending, my first reaction was kind of skeptical. I mean, you look at these non-conventional data and then try to make a lending decision. I actually visited Tencent and look at how they use social media data to make a credit risk assessment, and it turned out to be quite effective. This is based on a paper we did with some economists from IMF, looking at what we call horse racing analysis. We use the same set of data, two models. One is the banking model, and the other is the big tech model. I don't have time to get into it, but the short answer is it works. And in many cases, the big tech model is actually more reliable in predicting default. I'm not going to get into the detail. You can find what variables played important roles in the outcome of these banking credit risk assessment models. You find for the traditional model, it's essentially your credit history. But for the new big tech models, lots of unconventional variables play very important roles. This is my favorite exercise. What we did was we compare the borrowers with central bank credit registry information and those without. As you know, the traditional banks can make lending if you have a history, credit history, then it's relatively easier for them to make a decision. That's the number we saw on the top left. If you rely on the central bank credit registry information and make a decision, it's quite reliable. And if you add these digital footprints onto the model and you improve the quality of the prediction quite significantly. But the most important point from this exercise is because 92% of the borrowers did not have a history, credit history. And we just use the digital footprints to make a prediction. The result actually is better than you just rely on the central bank credit registry information. That is a very important part of financial inclusion. You are able to lend money to lots of people who never had any borrowing history, never had any record. But you can lend to them and you can still control the credit risk. And Huang Yi showed you earlier on the non-performing loan ratios are actually much better for these the new virtual banks. This is a similar story, and I'm not going to get into it. Basically, Smaller firms, firms in more remote areas benefit more from this new credit risk assessment approach relative to the traditional approach. This is another example. The exercise we did were all for e-commerce entities on the platform. And then there are a group of what we call the QR code payment shops. These rely on the QR code payment, but they're not really an integral part of the ecosystem. And you look at this, and I was shocked when I saw the number. Basically, if you, for instance, been using your shop, selling vegetables, fruits, or whatever you're selling on the street side, if you've been using this payment system for 12 months, you have the 60% probability of getting a credit line from this new lender. If you've been using something like 3 years, the probability for you to get a credit line is almost 90%. That is what I meant by financial inclusion. As long as you're part of the system, you're more likely to get a credit line, meaning if you want to borrow, you probably can borrow money from the lender. And once you start to borrow, if you're able to borrow from this new lender, you see a spillover effect. It makes you easier to borrow from traditional banks. This is what we call the spillover effect. And we also look at what kind of borrowers are more likely to get the kind of spillover effect. And I think pointed to, for instance, the figures in the middle and on the right, basically showing these females and these borrowers without the property are more likely to get the spillover from the big tech lending. This is, again, in my view, very important evidence of the so-called financial inclusion. These are the numbers from my bank, the growth of their SME lending for individual regions. This is for last year, and basically the darker the color means that lending increased much faster than the rest of the region. I have to tell you that at the moment, the absolute level of lending is still bigger in coastal regions. But you look at the growth really took place in the western region, in the remote areas. This is what I think, again, an evidence of financial inclusion. We also did a paper on Huang Yi mentioned about this potential financial stability when you replace collaterals using data for making credit risk assessment. You kind of minimize or weaken what Bernanke and his colleagues called the collateral channel of financial accelerator, and you probably will improve financial stability. So this is the basic story about the big tech lending. These are all from my own research. There are many other questions still outstanding. I'll just list them. On some issues, we have done some work, but I think more research efforts would be required in order to resolve all these problems. So the first question is, can this new approach withstand a big change, switch in economic cycles, so for instance, number one. The second question is, well, this is always from the officials, from the regulators, especially the central bank. They say, well, your lending is good, meaning it's inclusive, but they're very expensive. Now, I have many reasons to explain why that's reasonable, but I don't have time today. Some people, especially the borrowers, also say, well, this is convenient and very good, but they're too small to be meaningful. Huang Yi did a good job of showing you they actually support the business expansion. We kind of had difficulties in finding material impact on business growth. What we found was probably more about the convenience than supporting a business expansion. But we did find the material impact, the positive impact during the COVID period. During the COVID, the shops borrowed from the big tech lenders actually experienced a faster recovery of their businesses. In normal times, it was not very significant. The fifth question is, how does it change the transmission of monetary policy. We also did a paper, but it's still in the process of revising. The key finding is the big tech lending is probably more responsive on the extensive margin, not on the intensive margin. Using plain English language, when monetary policy expands, you're more likely to lend to more people than to lend more to the same borrower compared to the traditional bank lending. And finally, what about the systemic financial risks? Now, I talked about the financial accelerator implication. But if that mechanism is weakened, there could be some other new mechanisms. For instance, big tech lending actually focuses more on cash flows, transactions, and so on. What does it mean for the systemic financial risks? And the use of AI, what is the implication? So still there are lots of issues need to be addressed. And this is what Chen Long assigned me to discuss. So what is the relationship with the financial institutions? I thought about and look at what I just described to you, the jobs that big techs did. As I said, I focus more on lending business at the moment. I can theoretically, certainly looking from the big tech's angle, there are three things could happen. Number one, I think most important, when big techs involved in financial businesses, they mainly try to fill the gaps in the traditional financial services. So mobile payment, the big tech lending, online investment, and I could say when they started, they did lots of things that traditional financial institutions did not do. So it really is filling the gap and offering the new businesses. In that sense, they're not substitutes, they're more like a compromise. But there are areas now we probably see increasing competition. When mobile payment becomes so popular and widely used, I think there is a question if the credit card still has a future in China. That does cause some issues. The same for the SME loans. I said they're very small, they're short-term and so on, but they're expanding, they're growing. So I think the banks also feeling the pressure now, the competition could rise. Also the same for investment. So while the first step, the emergence of these big tech financial businesses are mainly to fill the gap, to fill the shortage, to satisfy the demand in the market. It could gradually change, and the competition could become more an issue. Finally, of course, and as you probably already know, there are lots of areas they're collaborating with each other. Certainly in the areas of lending, but also in open banking, just mentioned a possibility, but also investment and so on. So that's, I guess, from the big tech's angle, you look at the relations with the traditional financial institutions, particularly from the banks. What about from the angle of the banks? The banks probably will look at this new change. There are three dimensions. Number one, there is a new element of tech. Well, the banks themselves can also engage in the tech. Using the tech, and I will talk about the digitalization of the banks also in terms of the coverage, the options, and also the speed of reaction. They could transform the bank's business models themselves. Number two, obviously, competition is a very important factor. And in fact, my first paper in Fintech or digital finance was finding that the emergence of some investment products on the Fintech created the pressure on the bank's interest margins. And you start to change the pricing behavior. Regulation, there are some new issues emerging. So I think these are the directions where the bank probably can feel that pressures or new opportunities being created as a result of the emerging the big tech businesses. What the banks are doing, I guess in January you can think of 4 ways of responding. Number one is you can convert yourself into a tech platform, if you can. Number two is, well, if the tech sector is doing so well in terms of financial inclusion, maybe you can focus more on your traditional large corporate clients. Number three, there are banks do very well with the so-called relationship banking, and maybe you can strengthen your services and try to retain these customers, and finally to cooperate with the big techs. These are very common. We composed, my colleague, not mine, not myself, my colleague composed this index called the Digitalization Index of Commercial Banks. As you can see, it's rising very quickly, but somehow the pace slowed down during the past couple of years. This is by different groups of banks. You find the state-owned banks actually on the top, and then followed by these private banks. I suppose the private bank result is distorted by the new virtual banks, My Bank, WeBank, and also XW Bank. Joint Stock Bank, these are the first group that are doing pretty well in terms of digitalization. But then you find that the bottom group, city commercial banks, rural commercial banks, and foreign banks, they're lagging in terms of digitalization of the banks. This is also from my colleague. They just look at the textual analysis and just trying to find out what are the kind of keywords that the business is focusing during different periods. And I don't have time to explain the detail, but you find over time the emphasis was also evolving. Finally, this is also a paper we did. Essentially, this is my main prediction about to answer to Chen Long's question. What will be the impact on the commercial banks? Now, there are lots of impact, and I already mentioned. You could improve your efficiency, you could be pressured in terms of pricing and competition and so on, and you may also receive a lot of more regulatory focus. But then the key question I think here is the banks themselves also try to digitalize in response to this. Maybe it's as a part of a response to the big tech's innovation, but also because of a result of this so-called the fourth industrial revolution, and they're trying to do it themselves. The result, the tentative result, however, what we call the Matthew effect. You find that the big banks are doing well and are receiving positive results. The smaller banks trying very hard don't get the expected result. And I don't have time to explain to you why. I think there are many reasons. The number one reason is to be digitally efficient. You need scale, you need data, you need investment, and you need people like Hanghzou. Traditional banks, bigger banks can afford to some kind of elements, but smaller banks will be very difficult. So one very brave prediction I'll leave with you, which could turn out to be wrong, is that I think we have 4,000 plus banks in the country, and most of them are in trouble. To be honest, my colleague Justin Lin once had this theory saying the SME is becoming so important in the Chinese economy. Therefore, we need a lot small financial institutions to serve them, because the small banks are closer to the SMEs and they know these SMEs better. They could better service the SMEs. I think philosophically that's correct, but technologically that's outdated, because the big techs can do lots of things better than the small banks. The small banks will be squeezed. 4,000 banks, now they're having difficulties already. Whether that's a result of the tech the revolution or as a result of poor management, I don't know. But you look at the country, they are in difficulty. But I think if this process continues, I don't see a great future for all these small banks. Thank you very much.